Ashwini Agarwal, co-founder and partner with Ashmore Investment Management. Ashwini, good morning. Thank you for joining us. Ashwini, so far so good. US markets, looks like all the concerns in the world for US markets are over and Indian markets are chugging along. Now it's good to be optimistic. It's a welcome delight to see that macro positioning is great and it's good to see that flows have stabilized. But is this as good as it gets? Because in terms of news, in terms of bond yields, in terms of rupee stability, in terms of liquidity, we've got everything on our side.
So, Nikunj, you're absolutely right. There is a lot of things that have fallen into place, which is why the market seems to have done very well in December and the early part of January. But the one big concern which is looming globally and looming in India as well is sustenance of growth. I think growth rates are under pressure globally, and therefore they are under pressure even in India. In India, we have two additional headwinds in the sense that fiscal deficit for the government has been running higher than expected. So there is limited amount of headroom for the government to spend more money. And on the demand side, we are seeing a significant slowdown in demand, possibly arising out of agricultural incomes being low thanks to poor food crop prices, as well as the NBFCs being unable to lend and finance a lot of consumer products like automobiles, for instance, or even new homes in some instances. So I think slowdown is something that we need to keep a watch on. But yes, I do agree with you that on the positive side, the risks of an unruly sell-off seem to be more contained now as compared to how we were looking at things in October or November.
Okay. So Ashwini, what is the way forward now? We're off to a great start. Do you think this year we could be in for that exciting year which will be a stock picker's delight, whereas when you'll be able to identify companies, stocks and businesses and then make make good returns? Because 2018 frankly was not a stock picker's year. It was a year where if you bought large cap stocks like TCS, Reliance and its HUL, you actually hit a home run.
So I believe that India is always a stock picker's year. Even last year it was a stock picker's year. I think if you look at mid cap IT, that did phenomenally well. There were certain other areas where the market gave you a nice opportunity to make some money. Of course, the broad sell-off in the small and mid cap stocks did hurt the traditional stock picking that is done in that space. And here I think there will be a lot more opportunities this year, because in the mid and small cap space, I think valuations are beginning to look very interesting. Earnings growth and margin improvement appears to be on the card. So yes, I think you will see a lot of stock picking opportunities in the mid and small cap space. Even in the large cap space, I think you will see some amount of rotation, because if you look at companies and valuations, you see extremes both on high valuations as well as on low valuations. There is a set of companies that nobody wants to invest in, and there is a set of companies everybody is deeply invested into, where valuations are very high. So the valuation disparity obviously appears to me as a place for stock picking. So yes, you are right that 2019 will offer more choice by way of stock picking than 2018 did.
Ashwini, hi, morning. I don't know what's the official cutoff to wish Happy New Year. We're already 15 days done, but nonetheless, wish you a great 2019.
Happy New Year to you too, Tanvi.
Okay, it's Aisha here. Tanveer will be with us in just a minute, but just wanted to discuss in the more near term. There's all talk and hype around the big Brexit vote tonight. The UK Parliament is going to be voting on the deal which was struck by Theresa May. There is a lot of talk as to whether or not there's going to be a hard Brexit, soft Brexit. You don't know which way this deal is going to really go. Do you spell that this could mean, or rather, do you think this could spell chaos in global markets and thereby rub off on us also?
I don't think so, because the Brexit part of it is kind of being very closely watched. So let's see what happens today. But our sense is that that event is very significantly priced in. Number two, on the global side, I think policymakers across the board have started to take notice of softer growth, and that is starting to kind of get priced into the marketplace via lower interest rate, and that is something that people are starting to work towards. So both those things tell me that a big sell-off globally is probably not something that I worry about at this point in time. We also think that that the weaker dollar, which should be the story for 2019, is overall a positive for the emerging market story. We see fairly good traction in China in terms of policymakers' desire to boost the local demand and economy. So I hope that we will see more constructive data flow out of China as the year progresses. I mean, the numbers haven't been anything to write home about till now, but hopefully as the year progresses, things will improve. Obviously, these kind of slower growth and pressures will help a rapprochement between the US and China. That's what we hope. So I think overall, we feel that this year should be a year which is not a very big accidents, but hopefully we will go through with some air pockets, some speed bumps, but nothing close to a disaster. Let's see how it goes, but it's all open out there.
Question, Ashwini, on the macro premise, and especially last evening you got the retail inflation data. It's cooled to an 18-month low. Day before, or rather Friday, you had the IIP cooling off to a 17-month low. Do you think the premise is only getting stronger for a February rate cut by the RBI?
Yes, I mean, we think that there is enough room for a monetary stimulus to be introduced. We don't think there's any room for the government to provide more fiscal stimulus to the economy. But in terms of real interest rates being high, that is something which is a valid concern, and we hope to see a rate cut in February. Having said this, the read-through on inflation is also quite mixed, because while the headline CPI and WPI numbers are coming in lower than expected, the core inflation continues to be reasonably stable. So as the low food prices get built into the base effect, inflation later in the year will start to look up. So while we expect maybe 1 or 2 rate cuts in the first half of this year, I think the room for very aggressive monetary easing is also fairly limited from a medium-term perspective.
Ashwini, you're looking at one of your points to highlight in terms of an investment philosophy is that NBFC rebound is to drive auto sales. So do you think that the valuation adjustment that we're seeing in autos is now a compelling buy, because the kind of liquidity crunch that we saw on the NBFC side, if that gets resolved, then that will find its way once again into building auto demand?
I hope so. I sincerely hope so, because I think the liquidity concerns around NBFCs have largely dissipated. I think growth will remain softer for the next couple of months, but after that, hopefully the liquidity in the system will allow the NBFCs to start growing again, and if that happens, we should see a knock-on effect on auto demand. Structurally, I don't see any reason why we should be significantly bearish on auto demand in the long run in India. Transportation is a key personal need. We do have some improvement in public transport infrastructure happening in some of the large cities, but by and large, it's woefully inadequate in all parts of India. So personal transportation will continue to drive demand for two-wheelers and demand for cars. In trucks as well, we see a reasonably stronger 2019, especially ahead of the April 1, 2020 deadline for the new emission norms. So I think there will be some build-up in demand later this year. So normalization of NBFC finances will be a driver for auto demand in our view, and as you mentioned, stocks have corrected in certain areas. They do look quite attractive to us.
It could be the reverse also, right? On the auto demand front. Whereas you're making a case that because of new emission norms, demand would kick in. Our understanding with auto experts is, and this is Hormoz's view, the man who is the editor of Autocar, his view is that for the first 6 months, more than demand, you will see discounts because they will have to get the inventory out. So next 6 months, auto companies will not make money because they would be throwing bikes and cars at a price which is much below the average margins.
Nikunj, is possible. What you say is possible. I haven't looked much more deeply into this situation as to when does the new product start to get rolled out, and will there be hefty discounts offered to clear inventory. Again, I don't believe that the inventory is so deep and so large in the system that heavy discounting will take place. Also, my case for a recovery is a little bit back-ended towards the end of 2019 rather than in the first half. So yeah, and next few months could continue to be soft for auto because NBFCs also, remember, haven't started to grow yet. So auto trade, in my view, is a 2019 trade, but with a back-ended view. It's probably not going to play out in the first quarter, maybe not even the first 6 months. But honestly, this discounting and aggressive discounts to drive sales ahead of the new launches later this year is something that we don't know. We don't know on that count how things will play out.
Okay, having said that, I want to address another point of that you've highlighted as part of your investment philosophy, which is cherry picking in pharma as outlook is improving. Could you qualify that? In what way are you seeing there being signs of a change in the sector? Because, you name it, a lot of the stocks are suffering from a regulatory overhang, and that doesn't seem to, to kind of come to an end. There's a bit of a communication gap, but even as time passes by, somewhere or the other, the checks and balances are not falling in place. So how does one go about cherry picking in pharma?
So there are two parts to pharma. One is that we think that the pricing environment in the US has been so severe in the last 2 years that unless the pricing environment improves, you will start to see product shortages emerge. We are hearing this from a multiple number of CEOs of pharma companies, both in India and overseas. This was mentioned by two CEOs during the earnings conference calls for the September quarter in India, and of late you've seen similar noise bites coming out of the US. So that to me is it provides some hope that at least on the US pricing side you will start to see some improvement. Second is that you will start to see some follow through of the weaker rupee starting to feed through to earnings. Last year that pickup was relatively small because a lot of the revenues were hedged, and last year you also saw a significant amount of cost pressure on account of higher raw materials. That's also starting to normalize. Third thing is, the third facet is regulatory issues, as you pointed out. That to me is going to be an ongoing challenge. I think the US FDA is very clear that they want a certain level of compliance with anybody that's addressing the US markets, and I think the Indian companies have sort of upped their game to a point that these regulatory headwinds will become less sporadic rather than widespread. That's at least my hope, because we see a lot of companies telling us that yes, the goalposts had changed at some point in time and we took time to catch up, but everybody is very serious about making sure that they don't fall foul of what the regulations expect of them. And to that degree, I believe that we will see fewer accidents in the future than we have seen in the past. That's my hope.
Well, you got uptick coming in Reliance, and I think the uptick in Reliance is very, very evident right now. So Ashwini, let's get closing comments. Where do you think in this market there is still a situation of a great business going through temporary distress? Or where do you think markets are still not recognizing the potential comeback in growth and in earnings?
So that's a great question. I think there are several areas in the small and mid cap space where you have very good companies where stocks have sold off 40, 50, 60% over the last year, where balance sheets are improving, earnings trajectory is improving, where valuations are at -1 standard deviation of a past 5-year historical trend. Therefore, we see significant amount of value. In the frontline space, there are select areas where I think valuations are quite attractive. Of course, the outlook is unclear. Take the PSU banks, for example. You could argue that these are not the best run businesses in the country, but the valuations are absolutely undemanding. And if the credit cost normalization follows through, then I think you could see a significant amount of improvement in stock prices as the year rolls along. Obviously, there is a worry here that MSME loans could turn out to be the new problem that the public sector banks have to deal with. Let's see how that goes along. But that's yet another example of where something is definitely changing for the positive, which hasn't been recognized by the market as of now. Unfortunately, we are also dealing with delays in the NCLT resolution of bad assets. We were hoping that we would see a lot more progress on that by now, which has held back some of the write-backs. If we see that in the first quarter of this calendar year, we could see some positive surprises here. So that's another area in the large cap space where you could see some improvement. Another area could be in the area of metals. We don't track metals very closely. I found it very difficult to predict what happens to metal prices. But I think fundamentally, from a book value perspective, a lot of stocks are beginning to look very cheap. So there may be some opportunities out there. Last but not the least, oil marketing companies. They are now trading at valuations they were trading at prior to this whole deregulation unfolding 3 years ago. So we are back at a point where deregulation has been given up for dead. So you don't have a lot of downside here. So let's see how the market treats them as we go ahead.
So quite a few themes. And what about the reverse part, Ashwini? What you will not buy in this fall, because in this fall, a iShares has corrected, a Page has corrected, a Asian Paints has corrected. Would you be tempted to go back to the classic compounders?
Well, there will be some opportunities in these deep corrections. There's no denying that. But given our value framework, we find it very difficult to buy these really expensive stocks. But Nikunj, I was thinking about it this morning, that one of the reasons why these growth stocks have done spectacularly well over the last 5 years is because growth was very hard to come by. So wherever you saw some degree of assured growth, valuations didn't almost matter. And in my opening comments, I did mention that growth is coming through as the overarching concern all across the world. So if we again get into a growth funk in 2019, then you may see the names that you mentioned come back very strongly because of the assured growth that is coming through. From our portfolio and our value investment style perspective, we don't like very expensive valuations, whether it's in the consumer staples space, whether it's some of the names that you mentioned, or some of the really toppy valuations for assured growth that the market has been very happy to pay for the last several years. I mean, it doesn't work for us in terms of how we think about stocks and opportunities.
Okay, Ashwini, great to have you on the show. Thanks much for taking the time out and chatting with us.